Hello and welcome back to Volatility 411. I'm Kevin Davitt, part of CBOE's Options Institute, and it's Monday, January 10th. Interestingly, the 10th of January is when Julius Caesar and his legion crossed the Rubicon River into what was Italy. It precipitated the Roman Civil War and is now synonymous with the point of no return. Now, let's hope that last week wasn't a Rubicon moment for the broad market. The NASDAQ had its worst weekly performance since February of last year. The tech-heavy index sold off by 4.5%. It was the worst start to the year for the index since 2000. The S&P 500 fell by 1.9% as energy and financials held up relatively well. The VIX index climbed by about 1.5 handles last week and closed around 1875. You could read more about that in CBOE's The Week That Was on our Insights page. Now, as I stand here, U.S. equity markets are lower again. The S&P 500 is down by just over 1%. The NDX is off by 1.8%. The VIX index is higher by 270 and measuring around 2140. The markets remain focused on interest rates and in particular short-term rates. The 2-year note yield is approaching 90 basis points. For a frame of reference, the 2-year yield was 40 basis points on Halloween. This week, the markets will get the latest look at CPI and PPI data, which are expected to show continued inflationary pressures. At the end of the week, a handful of big banks will kick off earnings season. The VIX term structure isn't currently indicating any sense of panic. The relatively steep contango remains in place. The spread between standard January and February futures is around $1.40. For the sake of comparison, that month 1, month 2 spread was $1.70 wide on Friday's close. So, plenty to keep our eyes on this week. Inflation, rates, the Fed, and earnings at the tail end. That's Volatility 411. Thank you very much for tuning in.